there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised, and I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Tom Lee starts by breaking things down clearly. The crypto market is still dealing with the aftermath of the massive April 10th deleveraging event, the biggest in history. Weeks later, many market makers are still trying to rebuild their balance sheets and secure new capital. In practical terms, this means that every time prices begin to rise, sellers step in not because they doubt crypto's long-term potential, but because they need liquidity to shore up their financial positions. As a result, price growth keeps hitting resistance, which has weighed on both momentum and overall investor sentiment. This dynamic also helps explain why crypto has lagged behind equities since October 10th, even though broader risk appetite remains strong and the stock market has been performing well. If you're enjoying this content, don't forget to like the video, subscribe, and turn on notifications for future updates. Feel free to explore our other videos on crypto and digital assets, and share your thoughts in the comments below. Every interaction helps support the channel's growth. Thanks for watching and enjoy the video.
Ether's down 8.5% this week. Bitcoin's down 8%. Bitmine is down 20%. What's happening here?
Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Can crypto treasuries, like yours, for example, can they trade as well or in tandem with a cryptocurrency itself, or does one have to trade at the expense of the other? If I'm going to see money flow into Bitcoin or crypto treasuries, wouldn't it then come out of the actual pure play coin itself?
Not exactly, Scott. For instance, when Bitmine has shareholders and institutional capital comes in, and JP Morgan, Invesco, BlackRock are buying big stakes, then that capital is then used to buy Ethereum. So it's actually going back into the ecosystem, but then it's going into a vehicle like Bitmine that's actually a permanent holder. Bitmine owns 3.5 million Ethereum, more than 2.9% of the supply, but now that is not going to be subject to liquidations because there's no leverage used to hold that Ethereum. And then at some point, that 3.6 million or 3.5 million Ethereum is going to be staked and then generate nearly $400 million in net income. Well, that can create returns for shareholders. So in a way, a crypto treasury is actually a pretty attractive equity because there's an income component, plus there's, of course, that ability to grow your Ethereum holdings per share.
But what if crypto treasuries become more favored than crypto itself? There's no negative impact for either the way that Ether or Bitcoin would trade if just more money floods towards the treasury part of this story?
Well, one, it's a conduit because, as you know, equity managers, many of them, the 4,000, can't own crypto directly. So they have to get exposure to Ethereum by buying a stock like Bitmine. And Bitmine is the 438th largest stock in America today. It's not that different than if someone wanted to have exposure to energy. They can buy oil and trade a commodity, or they can take like oil barrels at home, or they can buy an oil-related stock, either a major or something in the supply chain. That's what crypto treasuries are, is essentially an asset class that gives you direct exposure to the crypto asset.
All right, let's pivot to the market itself. Is your confidence at all shaken in where we are and what you thought the prospects for an end-of-year run could be after what we've seen this week?
Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. but it is consistent with the idea that, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAI went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. In fact, maybe over 7,000 by the end of the month. I think it is going to be from time to time going to show extended weakness. But to me, the underlying story driving technology, which is the productivity miracle coming from AI, is still intact. Mary Erdos even talked about this earlier this week from JP Morgan, that there's been a payoff in spending, and Lisa Su at AMD as well as noting that productivity lift is the reason AI spending is rising. That's actually still a tailwind for tech stocks.
Tom, if I could just follow up, you manage funds now, especially an ETF that's heavily tilted in some ways towards some parts of that kind of technology, media, and telecom trade. Has anything changed with regard to the price action or the fundamentals that have taken some of those names perhaps out of your portfolios?
Dom, we just actually did a rebalance for the Granny Shots ETF, our large cap fund. We still actually have about 40% exposure to tech. It's about a market weight, but to us, the visibility and the spending is still very strong, and names like NVIDIA are still reasonably priced. I mean, NVIDIA at 28 times forward earnings is still less expensive than buying Walmart or Costco. Costco is almost 50 times forward earnings.
All right, Ross, with that in mind, as you watch the price action play out, does it surprise you at all that we've seen this kind of a sell-off? Could we expect more of this in the coming weeks?
I don't know if we'll get more of it, but investors should expect more of it. I mean, if you look even at the late 90s, during the heyday of the dot-com bubble, 96 double-digit sell-off, 97 double-digit sell-off in the NASDAQ, 98 big sell-off on LTCM and some other weakness, and then 99 even big sell-off in the NASDAQ. So double-digit sell-offs even in bull markets driven by new technologies and exciting new technologies are really common. And this one, is just par for the course, I think, amid a broader bull market. So as long as the technicals and the underlying trend isn't too damaged, I think it is a dip you can buy. But I think investors should always expect a little bit more weakness. We've been on a tremendous run off the April lows. That kind of momentum can't sustain forever.
Ross, do you feel as though there is any kind of a case to be made for a possible rotation trade? We've been exploring the possibility that maybe this broadening out could include less AI and tech and more things like perhaps energy or financials, something else along those lines. Does that thesis play out in the coming quarters in your mind?
Sure, and I think it's incredibly healthy that as AI is pulling back, we're getting some nascent leadership from things like energy. Healthcare has had a tremendous month thus far after being really beaten up for a couple of years. Financials, big banks, both in the US and globally, have held up solidly. So, obviously the headline indexes are going to be weighed if big tech sells off, but I think it's incredibly healthy both on the earnings front and on the price front that you're seeing some breadth, especially at a time when the question about the broader economy outside of AI is how healthy is it, right? So this is a really good sign to me, and I'm happy to take a little bit of gains from tech and rotate into some nascent leadership there in other sectors.
Tom, the tariff tantrum issues aside from earlier this spring, specifically in April, we haven't really seen any kind of a pullback last that long. It seems like these things are getting shallower, they're getting shorter in duration. If it is the case here, does it still play out that way? And if so, what exactly then goes on shopping lists? I mean, you mentioned your ETF, GRNY, Granny Shots. Is there anything that you would be thinking about buying more of? I know that the rebalance is already there, but what kind of stocks actually go and you want to buy on discount here heading to the year end?
Yeah, well, I think it is helpful to think about where we are in the cycle. I know the Fed is a little hesitant the reason to cut in December, but the reason they're hesitant to cut is the economy is actually pretty healthy, and they just don't have a clear contour of how quickly inflation's cooling. That's a very good backdrop for corporate earnings, actually even corporate earnings to actually start to spread. So if the Fed gives us some guidance and visibility about, path forward, I do think business confidence picks up. That means that ISM starts to recover, and it is a broadening trade. So I would agree with the other speaker that, I like tech structurally because of AI spending, but there's still plenty of room for the small caps to work, which have really taken it in the gut as the Fed's sounded hawkish, and the banks. And so I'd be in sort of favor of a broadening trade as well. But I still like tech. And as you know, the AI trade comes under question every few months. There's always a big pullback, but for the last 5 years, investors have had to buy that pullback.
We take a deeper look at Bitcoin dominance, BTC, through a cyclical lens. The data suggests dominance is likely to continue rising. Although investors may feel uneasy about short-term price movements, the larger trend is still firmly upward. Bitcoin dominance has climbed for 8 consecutive weeks. Pullbacks are normal and don't signal a shift in trend. With quantitative tightening still ongoing, and considering that dominance has historically peaked in the years following a halving, the current cycle fits established patterns. Major dominance tops typically form during periods of quantitative easing, not tightening, which aligns well with what we're seeing now.